One of the reasons I maintain decent win rate consistently is because I have a rich understanding of liquidity. If you don't understand liquidity deeply, you're always going to be used as liquidity by those who understands it. In this video, I'm going to explain all of this liquidity concept to you. You can use them as confluence to your trade, or the understanding of these can save you from unnecessary stop losses, right? When you see them at play, because sometimes the market can give you your setup, right? Even when the whole idea is just an inducement, it's just to create an inducement. So this is what this video is going to do for you. Open your eyes to know when there is an inducement and when the market is moving for real. Guys, if you like video like this that help you level up, please go ahead and click on the subscribe button so you can be part of the family. And also, guys, please click on the like button as well to motivate me to always create videos like this for you guys. All right, so without further ado, let's dive into it. So what is liquidity? First of all, liquidity is simply money, right? Liquidity is what moves price from one point to the other. Without liquidity, price will be moving, in a range, right? When there's no liquidity, price will be moving in the range. When there is no liquidity at all, price will stand still, right? There will be no movement. And we have several type of liquidity. We have the basic liquidity, we have the advanced liquidity. For the basic liquidity, we have things like trend line liquidity. We have things like trend line liquidity like this, right? And we have things like double top, double bottom, all of those type of basic liquidity that we know, right? I have a video on, basic liquidity. So if you want to know more about liquidity, you can check out that video. It's on this channel, right? And then we also have advanced liquidity. I've also taught advanced liquidity on this channel as well, where we say whenever price takes out a higher high to continue the trend, we say it is transactional liquidity. And how we explain that transactional liquidity is what is responsible for break of structure to maintain a trend. And we also explain structural liquidity, right, as the necessary liquidity that needs to be taken before price can continue movement, right? And so and we also explain inducement liquidity as well. So guys, if you haven't seen that video on liquidity, I'll leave a link in the description so you can check it out and become a better trader, all right? So in this video, we're going to focus on this concept listed here. The number one is liquidity void. What is liquidity void? This is what most of us refer to as imbalance, right? Liquidity void is in an imbalance. Now, price seeks efficiency, right? Price seeks efficiency. Price seeks balance between the buyers and the sellers. So whenever a price moves in an impulse, right, not paying attention to one party, price is always going to retrace, right, to correct that inefficiency. For example, this is an imbalance right here, right? This is a gap between candles, right? Gap between candles. Now, when you are considering an imbalance, you have to consider three candles, right? This is the first candle right here. This is the second candle right here, and this is the third candle, right? So you consider imbalance based on three candles. So if the three candles that follows, that precedes each other, if they don't overlap, right? The ideal way this candle should be formed is something like this, right? Something like this, so that they can overlap each other and then there will be no spacing between the candles. But since they fail to overlap each other, price will return eventually and fill up this imbalance that's seated here, right? Just to maintain efficiency in price action, right? And some persons actually trade, imbalance as their strategy, right? Where, they can price, and yeah, it works. It actually a strategy that works very well. Price can, retrace, tap into this imbalance now because of the huge order here, right? Price can decide to then push down, right? So trading imbalance works, right? The number two thing we're going to be looking at here for is liquidity trap. Liquidity trap. Now, when you hear the word trap, you already know what it means, right? It is an intentional way to have you locked up, within a space, right? Denying you of your freedom, right? That's what a trap, right, looks like. That might not be a perfect definition of a trap, but in this situation, that's how we are going to look at it, right? A trap, like these smart money traders, what they want to do is they try to set a trap for the retail traders just to get them in, right? Just to take forcefully take liquidity from them when they eventually take that bait, right? So that's why it is important for you to know when there is a trap in the market or when the market is moving for real. Let me change this to demonstration. Now, so how does this trap look like? How does this liquidity trap look like? Let's say price is moving this way, right? Let's say price is moving this way. If you agree with me, this is a rangy market, right? This is a consolidation market. This is a consolidation market where price, lacks the energy to break either to the upside or to the downside. So we refer to this type of zone as as a rangy market. This is a rangy market, right? Now, but this what price is actually targeting here, or what the smart money traders are actually trying to do here is they want to get everybody to participate. If the market is selling, for example, if the market is in a downtrend, the you know the population will be the sellers, right? And then there will be few buyers. But when you have a ranging market, you would have so much buyer who believe that price is going to break up to the upside, and then we have also so much sellers who believe that price is going to, sell down to the downside, right? And both of them will be taking trades from, this zone. So a lot of traders will take trades from this first zone. They are still holding their trades. These people here also still holding their trade because their stop loss is above this zone, yeah. And this is another trade as well, right? And then this possibly is another trade. So you can see how many trades. Maybe one trader would probably even take all of these trades, right? Maybe they would have taken 4 trades. Just one person would have taken 4 trades, holding them or stacking them, right? And also at this point as well, there will be lots of buys, right? There will be a lot of buys here, lots of buys here, a lot of buys here, right? Now, so both buyers and sellers are now locked up in this tunnel, right? In this tunnel. The buyers are here, the sellers are here. So what the smart money traders do is sometimes they're trying to maintain this range for a long time just to get more people in it, right? When they have the sufficient liquidity they need to open their position, then they do something like this, right? They do something like this. Boom, right? They take price to the upside. And when they're done taking that liquidity from the upside, then begin a lot of traders are going to say, okay, since price has broken out, this is now, a buying market, and then they are going to place their buy position here, right, at this other block, and price is going to eventually do something like this, right? Just come here and just give them the straight stop loss, right? So this is how liquidity trap works. And when they take out this zone here, they'll also take out all of these buyer stop losses as well. So they will take liquidity from the top and from the bottom, right? Now let's quickly look at the chart example. If we have a liquidity, okay, this is a perfect example of liquidity pool, right? Look at what gold is doing right here. Look at what gold is doing. Gold is going up and down, no impulsive move, right? No impulsive move here until recently. Look at what gold just did. Gold just broke down out of this tunnel, right? Gold just broke down out of this range. A lot of people are going to be in this market already, right? Now, after this breakdown to this zone here, the sellers are going to be like, okay, since price has broken down to this zone, it means the price is bearish, right? And also those that lost their positions here, the buyers that lost their positions here, since there is a breakout now to the downside, they are going to also assume that price is now selling. So what are they going to do? They are going to, place their sell position on this supply zone here, right? Some of them are going to take their trade from here. Some of them are going to look for somewhere, maybe somewhere here to take their trades, right? And with the aim of making profit. At the end of the day, this is what price is going to do. Price is going to then come here, right? And then take all of them out again, take all the sellers out. Everyone that entered at this zone, this zone, this zone, this zone, and this zone. Right, price will take all of them out before it will continue moving in the upward direction. So this is how liquidity trap is set for traders. And then we have liquidity pool. Now, liquidity pool often, is responsible for change of character, right? Most of the time when you have change of character in the market, it is often caused by liquidity pool. Now, what do I mean by liquidity pool? When you have a case of, maybe like equal low, right? Let's say you have something like this. You have equal low in one direction, right? Let's say you have equal low in one direction. Let's say price kept moving this way. Let's say it could even be two, right? It could even be two or three or even four, just the way it is, right? But you can see that price has equal low, and price creating equal low and failing to create a new high, right? So when you see this type of movement from price, it shows that price is about to go to the downside, right? Now, because for this thing to keep pushing from this zone, from this zone, this resistance zone, sorry, this support zone, it means there are a lot of orders here that are stacked. That's why price keep pushing upward, with momentum whenever it gets to this zone. So what would the market do? The market will then, come down and take everybody out, right? Come down and take everybody out. And maybe it was at this point that this person here started telling, this person here to, okay, buy more, stack more, that price is going to go up and all of that, right? At the end of the day, you end up, in a losing trade. So that's how liquidity pool works. The next thing we're going to look out for is liquidity sweep. All right. Now, this is one of my this liquidity sweep is very, very important to the strategy I trade, right? If I don't get a liquidity sweep, I'm not taking any trade, right? I need to see a liquidity sweep first before I'll decide to pick a trade. Now, what is liquidity sweep? Liquidity sweep is a situation where, be it an uptrend or a downtrend, right, where price get to take out a low, or yes, for a case of an uptrend, where price get to take out a lower high, right, before price will eventually continue that movement. Now, the reason why I want price to take out a low first before I enter the trade is because I know that this is a normal market structure setting, right, where lots of normal market structure traders will take their position here, right? They'll take their position here, expecting that price will react from this zone to the upside, right? So since they've identified the trend, since they've now, seen that price has, created higher highs and higher lows and all that, they expect price to react from an order block here or an imbalance and give them a good trade, right? But at the end of the day, price will disappoint them, take out this higher low, right? Before it will eventually even reverse, right? Now, even if price fails to even reverse to the top here, right, to take out this high, price can react to at least 50% of this zone. And if you take a trade from to the 50% of this, this impulsive high, this impulsive swing here, you're going to get at least 1:3, 1:, 4, and all that. And that's for me, that's cool, right? That's cool. So you always want to see price sweep something. You want to see price sweep. So even if you're trading just a normal market structure, right? You want to see price sweep something so that when price is coming back down again, you can just place your buy position here, right? And then since price has already taken liquidity, this zone is now protected. This zone now ought to be protected, right? So what is our anticipation? That price is going to come down here, tap into this zone, and then boom to the upside. So this would then be our anticipation, right? But before I take any trade, right, there have to be a sweep of something. It might not be a higher low, yeah, but it can also even be an internal low, maybe a low hiding somewhere here, right? I just want price to sweep something, just sweep something. Take out liquidity first, right? Before you make that impulsive move that broke structure, right? It's very, very important. It gives me very, very good win rate every time. And that's why I'm sticking with it. The last thing we'll talk about here is engineered liquidity. Engineered liquidity. Now, engineered liquidity is when, price is approaching your point of interest, right? And instead of approaching your point of interest aggressively this way, price starts to, engineer liquidity, try to, seduce people into entering this trade because they'll feel like, okay, since price is bullish, it means, okay, that means price is actually going up now. So they are just going to market execute. They are going to be jumping into these trades. A lot of people are also going to jump into these trades as well because they'll be like, okay, let's get this, right? Since they feel like, okay, price is actually in an uptrend. So they'll be like, okay, let's get this. Let's try to catch this move to the upside. But price will always keep taking them out, creating liquidity before it eventually get to the marked demand zone, right? So when price creates this type of lows and high before it gets to your valid demand zone, there is a high tendency that price is eventually going to play out, right? Because after taking all of this liquidity you see inside here and then still coming down again to take this liquidity from this other block that was responsible for this break of structure right here, right? It means that a huge order is stacked here, right? It means a huge order is stacked here. And also, right, this order is most likely to be respected because price has already taken so much liquidity already, right? So it will not have enough energy to actually fight to take out this low anymore, this low anymore. So that's why I always tell my students, when you have price, approach your entry zone aggressively, right? You don't take that type of trade. You don't take that type of trade, else you have a high chance of losing that trade. So guys, if you haven't subscribed to this channel, please go ahead and subscribe so that you can always get premium content like this that help you become a profitable trader. Also, I'll leave a quiz in the comment section to test your understanding of this concept. See you in the next one, guys. Peace.